WealthBranch.com.
Do you want to know why Warren Buffett's method outperformed his mentor's method, Benjamin Graham? Would you like to achieve a 25% annual return like Warren Buffett? Let's review some of the strategies from Benjamin Graham and Warren Buffett to see how these great investors made so much money.
What we really are looking for is an enduring competitive advantage. I mean, that's what's going through our mind all the time, and then we want obviously top-notch people running the place because we're not going to run them ourselves. So those are the two factors we look at.
Keep watching to find out how Warren Buffett improved upon Benjamin Graham's method to create a safer and more successful return. If you want to follow along, the textbook for this course is Warren Buffett and the Interpretation of Financial Statements: The Search for the Company with a Durable Competitive Advantage by Mary Buffett and David Clark. Please use our cost-free affiliate link to purchase the book below. The story of Warren Buffett owes part of his success to his mentor, Benjamin Graham. Ben Graham was a value investor and mentor of Warren Buffett. Graham's investing style was to focus on finding companies trading at less than half of what he thought they held in cash. He called it buying a dollar for 50 cents. Graham reasoned that if he bought these oversold businesses at prices below their long-term intrinsic value, eventually the market would acknowledge its mistake and revalue them upward. Once they were revalued upward, he could sell them at a profit. This is the basis for what we now know as value investing. Graham was the father of it. What we have to realize, however, is that Graham really didn't care about what kind of business he was buying. In his world, every business had a price at which it was a bargain. Graham also had other rules like never pay more than 10 times earnings, sell the stock if more than 50% return. If it didn't go up within 2 years, he would sell it anyway. Sign up for WealthBranch's email list to get access to the full list of Benjamin Graham's rules. Warren Buffett, on the other hand, after starting his career with Graham, discovered the tremendous wealth-creating economics of a company that possessed a long-term competitive advantage over its competitors. Warren realized that the longer you held one of these fantastic businesses, the richer it made you. While Graham would have argued that these super businesses were all overpriced, Warren realized that he didn't have to wait for the stock market to serve up a bargain price, that even if he paid a fair price, he still could get super rich off those businesses. Improving upon Graham's principles. After Graham retired, Warren returned to his native Omaha, where he had time to ponder Graham's methodology far from the maddening crowd of Wall Street. During this period, he noticed a few things about his mentor's teachings that he found troubling. The first thing was that not all of Graham's undervalued businesses were revalued upwards. Some actually went into bankruptcy. With every batch of winners also came quite a few losers, which greatly dampened overall performance. Graham tried to protect against this scenario by running a broadly diversified portfolio, sometimes containing 100 or more companies. Graham also adopted a strategy of getting rid of any stock that didn't move up after 2 years, but at the end of the day, many of his undervalued stocks stayed undervalued. Warren discovered that a handful of the companies he and Graham had purchased, then sold under Graham's 50% rule, continued to prosper year after year. In the process, he saw these companies' stock prices soar far above where they had been when Graham unloaded them. It was as if they bought seats on a train ride to Easy Street but got off well before the train arrived at the station, because he had no insight as to where it was headed. Durable competitive advantage. Warren Buffett speaks about durable competitive advantage in an annual shareholders meeting.
We don't have any notions as to what we want to buy based on how their costs are segmented. What we really are looking for is an enduring competitive advantage. I mean, that's what's going through our mind all the time, and then we want obviously top-notch people running the place because we're not going to run them ourselves. So those are the two factors we look at. We want to understand the cost structure, but Charlie and I can understand the cost structure of many companies. There's many we can't, but we can understand them of a good many companies. And we don't really care whether we're buying into a people-intensive business, a raw material-intensive business, a rent-intensive business. We do want to understand it and understand why it's got an edge against its competitors. Charlie?
Yeah, basically,
To some extent, we're like the hedgehog that knows one big thing. If you generate float at 3% per annum and buy businesses that earn 13% per annum with the proceeds of the float, we have actually figured out that that's a pretty good position to be in.
It took us a long time. Incidentally,
Warren Buffett often speaks about durable competitive advantage. Let's decode what he means. By learning about the business economics and reviewing financial statements of companies, Buffett learned that great companies all benefited from some kind of competitive advantage that created monopoly-like economics, allowing them to either charge more or sell more of their products. In the process, they made a ton more money than their competitors. Warren also realized that if a company's competitive advantage could be maintained for a long period of time, if it was durable, then the underlying value of the business would continue to increase year after year. Given a continuing increase in the underlying value of the business, it made more sense for Warren to keep the investment as long as he could, giving him a greater opportunity to profit from the company's competitive advantage. Warren also noticed that Wall Street, via the value investors or speculators, or a combination of both, would at some point in the future acknowledge the increase in the underlying value of the company and push its stock price upward. It was as if the company's durable competitive advantage made these business investments a self-fulfilling prophecy. There was something else that Warren found even more financially magical. Because these businesses had such incredible business economics working in their favor, there was zero chance of them ever going into bankruptcy. This meant that the lower Wall Street speculators drove the price of the shares, the less risk Warren had of losing his money when he bought in. The lower stock price also meant a great upside potential for gain. And the longer he held on to these positions, the more time he had to profit from these businesses' great underlying economics. This fact would make him tremendously wealthy once the stock market eventually acknowledged these companies' ongoing good fortune. All of this was a complete upset of the Wall Street dictum that to maximize your gain, you had to increase your underlying risk. Warren had found the holy grail of investments. He had found an investment where, as his risk diminished, his potential for gain increased. To make things even easier, Warren realized that he no longer had to wait for Wall Street to serve up a bargain price. He could pay a fair price for one of these super businesses and still come out ahead provided he held the investment long enough. And adding icing to an already delicious cake, he realized that if he held the investment long term and he never sold it, he could effectively defer the capital gains tax out into the far distant future, allowing his investment to compound tax-free year after year as long as he held it. Let's look at an example. In 1973, Warren invested $11 million in the Washington Post Company, a newspaper with durable competitive advantage. And he's remained married to this investment to this day. Over the 35 years he's held this investment, its worth has grown to an astronomical $1.4 billion. Invest $11 million and make $1.4 billion? Not too shabby. And the best part is that because Warren has never sold a single share, he still has yet to pay a dime of tax on any of his profits. Graham, on the other hand, under his 50% rule, would have sold Warren's Washington Post investment back in 1976 for around $16 million and would have paid a capital gains tax of 39% on his profits. Worse yet, the hotshot stock pickers of Wall Street have probably owned this stock 1,000 times in the last 35 years for gains of 10 or 20% here and there and have paid taxes each time they sold it. But Warren milked it for a cool 12,460% return and still to this day hasn't paid a red cent in taxes on his $1.4 billion gain. Summary: Buffett switched from investing in undervalued companies to companies that had a durable competitive advantage or a legal monopoly. Because not all of the undervalued companies would recover and some went bankrupt while the monopolies would keep growing, instead of selling companies that returned 50%, he kept them for longer. Do you like to find undervalued companies, or would you instead pay more for monopolies? Comment below and sign up for our website if you want to see the full Warren Buffett checklist. Please like this video if you found it useful and tell us what stocks you like below. Please share with your friends so they can learn to invest with you. And of course, subscribe so you don't miss a tip or video that could save or make you money.